Good morning and welcome back to the Money Advantage podcast. Bruce, it is a pleasure to see you today. And I know that due to this day, we are doing a little bit of a shorter podcast. So we have about 25 minutes, and we are going to be talking to you today about how to understand infinite banking. Now, the reason why we're doing this podcast is that we're in the middle of a series on becoming your own banker, and that is Nelson Nash's signature work here, Becoming Your Own Banker by R. Nelson Nash. And we are on part 30 of this series, Bruce, that we have been slowly proceeding and progressing through the book. And the reason so many episodes are in the series is because it is extremely important for you to understand how infinite banking works so that you can take advantage of this powerful strategy. And there's no better way than to go back to the source document and the source material, which is Nelson Nash's book. So if you have been following along, yes, we are in the glossary section of this book. And I say that a little tongue in cheek because normally you probably wouldn't cover a glossary of terms in a book study, but we are covering the glossary of terms because it's really important that you understand fully what Nelson Nash laid out in this book. However, what we're going to do is explain the process of infinite banking and how it works as we explain these terms. So today, Bruce, I'm really excited to jump in. And before I take us to really the start of understanding how money works and how infinite banking plugs into this, I just love to hear from you about where we are in the midst of this, the end of this series, and why infinite banking is so important.
Well, I think I run a IBC mastermind series, and we talk about different aspects of the book and then understanding. And I think we've come to a consensus that although maybe you should understand all the details as a agent, the reason that we understand all the details as an agent is because one, we uh, have faith that what Nelson said was correct from his simple ideas and diagrams and folksy way of wisdom. And then you don't have to understand it 100% because, as Nelson said on many occasions, it's more caught than taught. And what he meant by that is that you actually have to use it to understand it's exactly what you're currently doing in a conventional bank. And people overanalyze this all the time. This is simply about developing a pool of money. It's not about the rate of return, which everybody wants to talk about, because you're not getting a rate of return in the bank right now anyway. And yet people don't question why they have the money in the bank. So, really, it's about developing a pool of money that you can then access to take the finance charge out of your life. And when you come upon opportunities in your life, to then use that for investment. It's really that simple. And yet people continue to make this about rates of return. They continue to make it about whether we should have a high death benefit or a low death benefit, whether we should have really high cash value or low cash value. It's really about just developing a pool of money. And I can prove that because many of Nelson's policies that he owned over were all base policies. And so they did not develop cash value whatsoever. We actually did a case study yesterday in our study group where we had a state farm, which was all, it was all base. And yet, 42 years later, whenever you made the premium payment, the cash value went from the premium was $154 a year. The cash value increased by $555 a year.
So I want to clarify something because you said the cash value didn't increase whatsoever. I think you meant when you have an all base policy that you don't have early cash value. There
Correct.
still is a
Thank you,
cash
Rachel.
value
Thank you.
inside of a
Yeah,
death or
correct.
inside
Thank
of
you.
a whole
Thank you.
life policy.
Correct. Thank you for clarifying that. So I just want people to, when they're listening to all this, everybody has this desire to know I believe to know the ins and outs and making sure they're, doing the right thing. But, this has been this concept has been around since the beginning, even before Nelson gave guidelines.
Mhm.
I've given plethora of comments on this podcast how I've used it over my career, even before I knew Nelson. So this isn't anything that is some magic formula that only works under certain conditions. It's a pool of money. So I think that's a big thing that
Yes.
people need to, as we go through this part. And it's funny.
Yes.
The title of this is Basic Understandings. Basic Understandings.
Yes.
And then right in the middle of the paragraph it said this is about absolute control, and control Nelson put in capital letters.
Absolutely. Absolutely. Absolute control. So let's go ahead and dive in because today is really important for you, especially if you are brand new to infinite banking or the idea of infinite banking. You've heard the term, you want to understand what it is and how it works. It's also extremely critical to you if you are years or even decades into having infinite banking in your life and you want to understand it better so that you can explain it to somebody else, or you really maybe feel that you have gotten lost in the weeds of understanding how it works and you want to come back to the why. We are going to come back to the why today of understanding the basic simplicity of infinite banking with an illustration, or I shouldn't say an illustration, in life insurance terms, but an illustration like as in a book illustration, a diagram, a picture that will help you to understand how this works like a children's book, because when you have a picture, you can understand things much better than just having the words. So the first thing that I want to say is that as we talk about money in general, it is about the flow of money and how it moves from one person's hands or one reservoir to another. And this is an analogy that Nelson extrapolates through the book. I'm not going to point back to the exact page number where he starts this analogy, but if you think of water on the earth, you have it pooling in oceans, you have it flowing through rivers into lakes, you have streams, you have collection places where water exists, and then it evaporates, and then it is up in the stratosphere, the atmosphere in the form of clouds, then it precipitates and rain comes down to the earth, and you have the water cycle. Water doesn't cease to exist, it just accumulates or conglomerates in certain places, and then it has a flow. So it's either evaporating, or it's condensing, or it's flowing, or it's sitting. It's doing something wherever this water is. And money is like that in the world because you have a personal economy. The next neighbor to you has a personal economy. Your city has an economy. Your bank has an economy. And you can think about where money goes and where it flows. And all money is moving on a regular basis through transactions and trade, through printing of the money at the Federal Reserve. We have through taxation. We have money sitting in banking institutions. You have money sitting in mortgage institutions. And what we're talking about today is where money is, the pool of money. So the real question is, where is that money pooling? Where is it sitting? Where is it flowing? And who controls or provides access to the pool of money? So Bruce, before I show the picture, sorry for the burp in the background. That was the baby, not me. So before I pull up the picture that we're going to discuss today, what would you like to share about that? I know we're on a limited time today.
Well, I just think that you did a great job with the water cycle, and a lot of people misconstrue that because of financial gurus will often say you got to get your money flowing, you got to get your money working for you, so on and so forth. Um, and yet, one of the what's considered the greatest investor of all time, Warren Buffett, is actually sitting on a pool of $150 billion with Berkshire Hathaway. I just confirmed that yesterday.
Mm.
Um, and so he has a pool of money that is just like a lake that's just sitting there with tranquility, waiting for something to do, waiting for somebody to use it. And then he'll flow it to certain investments, and then the investments will actually return that money to the pool. Same way where you were talking about the money, the water will evaporate, it will condense, it will rain, it will flow down a mountain right back into the lake again. And so money has the same type of movement.
I'm going to show an image because what's really important to understand is when you use infinite banking, you are participating in the flow of money. And what we want to think about is where is that money pooling? Because it's pooling in your own life. You're storing it somewhere. It's also pooling in the hands of finance companies and organizations. When we talk about whole life insurance with infinite banking, we're talking about a pool of money held at an insurance company. I'm sharing a diagram from, Bruce, can you see that on the screen?
Yes.
Okay, so I'm sharing a diagram from page 55 of Nelson Nash's book. And the reason that we're showing this today is that he has several words like gophers and gatekeepers and financing and so many terms and definitions that only make sense in the context of a picture. So I'm going to explain this as quickly as possible. First, this is the pool of money. If we think about money flowing, this is a pool of money specifically held at a life insurance company. How does that money get into that pool? Well, first, one of the ways is by people paying premiums. So you can see, I think I can draw on the screen and I should be able to do that quickly here. You can see that this in the center is the pool of money. How does it get there? One way is through premiums. This is people paying premium dollars for life insurance policies. And that is the primary way that money is coming into the pool of money. Then we have money coming out of that pool. The insurance company is paying, number one, death claims. This is one of their greatest expenses. This is mortality charges. When people pass away, they have the death benefit paid to the heirs. They're also then paying the expense of operations. So these are all of their operational costs. And when they have factored in all of the death claims and the expense of operations, plus they're holding reserves at that company, they then calculate what their growth is, and they distribute that growth when you're with a mutual company in the form of dividends. So this is money coming out. I should have used a different color, but premiums are going in to this pool of money at the insurance company. Then out is coming death claims, expense of operations, and dividends. Now, this becomes very interesting. I'm going to explain it super quickly, and then Bruce, I'd love to have you add into this concept. The insurance company needs to think about how to increase the supply of money, not just through premiums, but through other mechanisms as well. That pool of money is very valuable at the insurance company because just like at a bank, if there is money sitting somewhere, that person or that entity that owns that pool of money has control over it and the ability to send money out to other people who would like to use it and charge a interest rate for the use of that money. They control it. So if somebody else wants a piece, they have to pay in order to access that capital. One way that a life insurance company makes money is by sending money out to, they talk about finance companies here, through gatekeepers and toll takers. That is other entities and organizations that are financing companies. Think of your auto, he mentions GMAC, which is GMAC. He mentions
Financing. Yeah.
yes, GE Credit, so General Electric Credit. These are financing companies that are borrowing capital from the life insurance company through a gatekeeper or toll taker. Think about that. If you go to the car dealership and you're going to purchase a car on financing, where did that car company get that capital from to be able to finance with? They're getting that from a pool of money, often at a life insurance company. And in order to do that, it's coming through that gatekeeper and toll taker at the insurance company that's saying, here's how you can get capital out. So it's a two-step process to get to us who are doing financing. What is very interesting is that instead of just sending it out to large finance companies, the insurance company can also send money out to you, a policy holder. And you don't have to go through the gatekeepers and toll takers, through an intermediary company. You instead can go directly because you are a policy owner. You have access to capital by borrowing against your cash value. So these loans to policyholders here are money coming out of this money pool to you, the policy owner. And then as you repay your loans, this loan repayment is more capital that is going into the pool of money. Bruce, I'd like to turn it over to you to add to that explanation.
No, that was a great explanation. I think the keys here are that oftentimes people don't realize when they go into a bank and they have money in the bank that the bank is loaning you money for, let's say, a car. Where are they getting that? Well, they're getting it from the depositors. So really, they're loaning your money to them, and you're paying an interest rate, and you're not getting any of the benefits of that. And oh, by the way, you have to apply for that loan to make sure, in the bank's mind, you're worthy of the loan.
That's why he
So
calls it a
where does
gatekeeper.
that's exactly right. And then they're not going to give you that money that's in the bank because they want to keep that money on deposit, and they have to keep a certain amount in reserve. They may go get money from an insurance company, and then the finance company GMAC, like you mentioned, gets that from the pool of money. They pay the insurance company a small percentage of the interest, and then they loan it out to you and charge you a greater interest. So the why not just skip the GMAC financing, go right to the pool of money that you've developed at the insurance company? Once again, you're not going to take your money out, just like the bank didn't literally go to your account and give you your money back. You're going to take it from the reserves. So your money continues to compound. And yes, there is an interest rate, but that interest rate is not as important as the control, because that's the other key to this is you are in first position, and all you have to do is sign and say you want a loan. That's all you have to do. And who cares if you pay an interest rate? When you pay an interest rate, it goes back to the pool of money that you own as a policyholder. So your
Yes.
returns are greater on that side. It's all about control.
So to illustrate the two-step process, if you go to a finance company that's borrowing from the insurance company, you're taking money from the pool of money out through the gatekeeper, and then you are having to repay the gatekeeper. You're having to repay the finance company. Instead of having to qualify that way, you can just take money out as a policy loan and then repay it back to the insurance company. This is what allows you to have that position of control. And the way that Nelson illustrates this, he said the gatekeeper or toll taker, the gatekeeper or toll taker is any intermediary that controls access to the pool of money or the bank. He says the gopher, then this is not a banker. The gopher is any administrator working inside a banking system. They don't work at the bank. They don't work at the bank. Gophers work at the bank, and they're given long titles to offset their low pay scale. I'm sorry. Bankers don't work at the bank. So he said gophers work at the bank, and they're given long titles to offset their low pay scale. Real bankers are found on the golf course or in all probability running some other business. What he's saying is the bank teller, the banker that you go sit and talk to, they do not own the pool of money at the bank. Instead, they are managing and facilitating the transaction. But the person who owns the capital of the bank, they're not sitting inside the bank getting a paycheck from the bank. You can, like the actual banker who owns the pool of money, become a banker by owning a life insurance policy. Then he talks about the Great Wall of China, which is the barrier limiting access to the pool of money except through the gatekeeper. You can avoid the gatekeeper altogether by storing up a pool of capital here inside of a whole life insurance policy, having access and control. And because you are controlling that access and that capital, you now have the ability to take policy loans without having to qualify and have loan repayment that gives you control. Bruce, we covered a lot of ground in a very short time. Is there anything that you would like to add before we close today?
I would say the only thing I'd like to add is Nelson was such a wise man. I actually played golf last week with two guys
Because you're a
that
banker,
actually
Bruce.
are shareholder. What's
I
that?
said because you're a banker, Bruce.
Well, that not only that, but they were actually investors in a commercial bank,
Mm.
or I shouldn't say a commercial bank, in a regional bank. So they didn't have anything to do with the day to day, figuring out whether they are going to give loans or so on and so forth. They had the gophers, as Nelson called it, doing that, and they're out on the golf course with me. And so this what Nelson said is actually true life values. And as I just think I want to close with this thought is that people really look at this as a complex situation. And it really is ridiculously simple. People just make it complicated. And why do they want to make it complicated? Because I think they do not want to admit that they're contributing to the problem of the commercial banking system. And that's understandable because they have trained us to think that's the only way that we can actually participate in the system is to contribute to the system.
Absolutely. I think that is a great place to close. There's so much more that could be said, but I think this value of having a very short, compact episode for you today is that it really is that simple. So if you would like
I agree.
to take control of the banking function, own a pool of capital, have that control, that accessibility, then book a call with our team. You can go to themoneyadvantage.com and get on our advisor's calendar to figure out how this can work for you. In closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.